Monday morning, 15th of December 2025. The opening bell rings in New York. The screens flash green. Silver surges past $63.80 in the first 15 minutes of trading. If you panic sold on Friday afternoon, if you let the algorithms shake you out at $61, you just made the most expensive mistake of your financial life. Because what you witnessed on Friday was not a crash. It was not a correction. It was a transfer mechanism. It was a calculated liquidity event designed to strip assets from the impatient and hand them to the informed. Look at the headlines from Friday afternoon. Silver rally overheated. Speculators flee as bubble pops. Industrial demand weakens. That is the consensus view. That is the narrative they fed you while the price was dropping. They told you that markets are efficient. They told you that the price fell because there were more sellers than buyers. They told you that the move to $65 was irrational exuberance. They lied. The price didn't fall because of sentiment. The price didn't fall because Samsung decided to buy less silver. The price fell because of a technical gap on the chart at $61.03. The algorithms were programmed to fill that gap. They hunted that liquidity. They triggered your stop losses. They painted the tape red to convince you that the bull market was over. And the moment the gap was filled, the moment the weak hands were flushed, the smart money stepped in and bought the entire float. Why? Why would institutional capital be buying a crashing asset on a Friday afternoon? Because they have information that you don't. While you were staring at the red candle, while you were worrying about the Federal Reserve, while you were reading panic tweets from retail traders, something happened in Suwon, South Korea that makes the price of paper silver mathematically irrelevant. A document was finalized, a production roadmap was confirmed, and a chemical equation was solved. Samsung SDI has officially locked the specifications for the S-line. The media is calling it a battery breakthrough. They are talking about 900-mile range. They are talking about 9-minute charging. They are talking about the death of the combustion engine. But they are missing the single most important detail. The detail that Wall Street hasn't priced in. The detail that the mining companies haven't prepared for. The secret ingredient in Samsung's new battery isn't lithium. It isn't cobalt. It isn't nickel. It is silver, and not just a trace amount. We are talking about a massive structural increase in consumption per vehicle. We are talking about a technology that moves silver from being a precious metal to a strategic energy metal. The banks are playing a paper game. Samsung is playing a physics game. And physics always wins. Welcome to capital cycles. We do not read the news. We extract the mathematical truth. And the truth is that the global silver market is no longer operating under standard equilibrium conditions. We have officially transitioned from Mode B accumulation into Mode C the shift. Let's strip away the noise. Let's look at the forensic evidence of what actually happened in the R&D labs. Because the math tells a very different story than the price chart. To understand why this Samsung news is an extinction-level event for silver supply, you have to understand the chemistry of the dendrite. For 30 years, the world has run on lithium-ion batteries. Your phone, your laptop, the Tesla in your driveway, they all use liquid electrolytes. They are great, but they have a fatal flaw. When you charge them too fast, the lithium ions form jagged little needles called dendrites. They grow like roots inside the battery. Eventually, they pierce the separator wall. Boom. Short circuit. Thermal runaway. Fire. This is why EVs take 45 minutes to charge. You have to charge them slowly to prevent the explosion. The holy grail has always been the solid-state battery. A battery with no liquid, no fire risk, instant charging. Every company from Toyota to Volkswagen has been promising this for a decade, but they all failed. Why? Because they couldn't stop the dendrites from forming on the anode. Graphite didn't work. Silicon expanded too much. Pure lithium metal was too unstable. Then the researchers at Samsung found the solution. They discovered that one specific element, when applied as a nanocomposite layer, completely solved the problem. It allowed the lithium ions to move freely, but it stopped the dendrites cold. It was stable, it was conductive, it was perfect. That element is silver, specifically a silver-carbon nanocomposite layer. This isn't a theory. This is published science in Nature Energy. The silver acts as a host for the ions. It dissolves them evenly, preventing the spikes from forming. This allows the battery to be smaller, lighter, faster, and safer. But there is a catch. A massive catch. To make this battery work, you need silver. And you don't need micrograms of it, you need grams of it. Forensic estimates suggest the loading is approximately 5 grams per cell. Now let's do the math that the IEA refuses to publish. A standard AV battery pack is roughly 100 kilowatt hours. It contains hundreds of cells. If you aggregate the surface area of the anode across the entire pack, you are looking at a total silver load of nearly 1 kilogram per vehicle. 1 kilogram. That is 32 troy ounces. In a single car. Let's contextualize that number. Right now, a standard combustion car uses about 20 grams of silver. Switches, electronics, defrosters. An electric vehicle uses about 50 grams. Inverters, connectors. But a solid-state EV using the Samsung standard uses 1,000 grams. That is a 20-fold increase in consumption per unit. There are 90 million cars produced globally every year. If just 10% of them switch to this technology, that is 9 million cars. 9 million cars times 32 ounces. That is nearly 300 million ounces of new silver demand. That is more than the entire annual production of Peru. That is more than the entire annual production of Mexico. And that demand does not exist in a vacuum. It is colliding with a solar industry that is already consuming 200 million ounces a year. It is colliding with an electronics industry that consumes 300 million ounces. We are already in the 5th consecutive year of a structural deficit. The cumulative deficit is over 1 billion ounces. The warehouses in London are draining. The registered stocks on the COMEX are depleted. So where does the silver come from? It cannot come from the mines. Global mine supply has been flat for a decade. Ore grades are collapsing. It takes 10 years to permit a new mine. So if Samsung needs 300 million ounces by 2027, they cannot dig it out of the ground. They have to take it from the existing stockpiles. They have to take it from the vaults. They have to take it from you. This is why the price action on Monday morning is so violent. The smart money knows that the inventory buffer is gone. They know that the next phase of the silver market isn't about speculation. It is about procurement. It is about survival. If Toyota doesn't get the silver, they can't build the car. If Samsung doesn't get the silver, they can't ship the battery. They are inelastic buyers. They don't care if the price is $63. They don't care if it is $100. They will pay whatever the market demands because the alternative is bankruptcy. This is the divergence. The paper market is focused on the Federal Reserve. The physical market is focused on the periodic table. And while the paper traders were selling the gap fill on Friday, the industrial procurement officers were likely locking in supply contracts for the next 5 years. Now look at the technicals, because the chart confirms the chemistry. Top analysts like Michael Oliver have been screaming about this structure. He calls it a silent breakout. He tracks momentum, not price. And his quarterly momentum indicators just broke a 40-year ceiling. This suggests that the move past $50 wasn't the top. It was the starting gun. He projects a rapid move to triple digits based purely on the structural tension in the market. And Peter Brandt, a legend who has traded since the 1970s, he calls this current setup a generational low. He compares it to buying Bitcoin at $1. Why? Because the gap fill at $61 completed the pattern. It flushed the leverage. It reset the sentiment. And it turned the resistance into support. We are now sitting on a launch pad. The buy zone was $61. If you missed it, you missed the easy entry. But the opportunity zone is anything below $100. Because once the Samsung narrative goes mainstream, once the average investor realizes that a car battery needs a kilogram of silver, the panic buying won't be for paper contracts. It will be for physical metal. Most analysts are looking at the chart and seeing a double top. I look at the chart and I see a coiled spring. They see resistance at $65. I see a vacuum. Because resistance only exists when there are sellers willing to sell. But in a Samsung world, who is selling? Is the miner selling? No, they are struggling to keep the lights on. Is the recycler selling? No, because you can't recycle a battery that hasn't been built yet. Is the investor selling? Only the ones who don't understand the math. This creates a scenario known as a supply cliff. The price rises, but the supply does not respond. Usually in economics, if the price goes up, supply goes up. Miners dig more. People sell their jewelry. But silver is different. Silver is a byproduct. 80% of it comes from mining other things. So even if silver goes to $200, the copper miner isn't going to double his production just for the silver credit. He is constrained by the copper market. This means the supply curve is vertical. It is inelastic. And when you throw an inelastic demand curve, like a billion-dollar battery factory that needs silver to function, against an inelastic supply curve, like a depleted geological resource, you get a price explosion. You get a vertical move that defies all technical resistance. This is what happened to rhodium in 2020. It went from $2,000 to $30,000 in months. Why? Because the car industry needed it for emission standards, and they couldn't get it. Silver is the new rhodium, but on a much larger scale. Friday was the warning shot. It was the last shakeout. The last attempt by the paper shorts to cover their positions before the deluge. Monday is the confirmation. The gap is filling. The buyers are returning. And the narrative is shifting from inflation hedge to industrial necessity. You are not buying a rock. You are buying the bottleneck of the energy transition. You are buying the only element that makes the green revolution possible. And there isn't enough of it. But knowing that there is a shortage is not enough. You need to know exactly how deep the hole is. You need to know if we can recycle our way out of this trap. And most importantly, you need to know if the thrifting argument holds any water. Because if the engineers can design the silver out, then the thesis fails. But if they can't, then we are looking at the math of extinction. And that is exactly what we are going to calculate next. There is a number that the mining CEOs are whispering about. A number that the bullion banks are terrified you will discover. It is not $63. It is not $100. It is zero. Not zero price. 0 days. 0 day is the calculated date when the available above-ground inventory of silver matches the immediate industrial demand. It is the moment the buffer hits the floor. And thanks to the Samsung revelation on Friday, that date just moved forward by 5 years. Welcome to part 2 of the silver bomb. In part 1, we established the chemistry. We proved that the solid-state battery requires a silver-carbon anode. We proved that this technology is not a science experiment. It is a manufacturing reality. But knowing the chemistry is not enough. You have to run the math. And when you run the math on what Samsung, Toyota, and Volkswagen are about to do, you realize that we are not looking at a bull market. We are looking at a mathematical impossibility. Let's calculate the math of extinction. We start with the base case, the world as it exists today, before the Samsung bomb fully explodes. Total global mine supply is 830 million ounces per year. Recycling supply is roughly 180 million ounces. Total supply is just over 1 billion ounces. Now look at demand. Industrial demand, solar, electronics, 600 million ounces, jewelry and silverware, 200 million ounces, investment coins and bars, 250 million ounces. We are already in a deficit. We are burning 50 to 100 million ounces of reserves every year just to keep the lights on. Now introduce the Samsung variable. Let's assume a moderate adoption of solid-state batteries. Let's say by 2028, 20% of new electric vehicles use this technology. And let's use the conservative forensic estimate of 50 grams per vehicle. Global car production is 90 million units. EV market share hits 40%. 36 million EV. 20% of those use the silver-carbon anode. That is 7.2 million cars. 7.2 million cars times 1.6 ounces. Equals 11.5 million ounces. That hurts, but it doesn't break the world. But wait, that assumes a tiny efficient car. That assumes the thrifting works perfectly. What about a Ford F-150 Lightning? What about a Cybertruck? Those batteries are massive. They don't use 50 grams. They might use 500 grams. If the average silver loading across the fleet is closer to 200 grams, and if adoption hits 50% of EV, let's rerun the numbers. 18 million cars times 6.4 ounces equals 115 million ounces. 115 million ounces of new demand. That is more than the entire annual production of Peru. That is equivalent to another solar industry appearing overnight. Where does that 115 million ounces come from? The market is already in deficit. The vaults are already empty. There are only 2 places it can come from. Number 1, price destruction. The price goes so high that people stop buying jewelry. Number 2, investment cannibalization. The price goes so high that you sell your coins to Samsung. This is the extinction equation. Total supply is less than solar plus electronics plus batteries. We aren't even counting investment demand anymore. The industrial demand alone threatens to consume 100% of the mine supply. If that happens, silver ceases to be a monetary metal available to the public. It becomes a critical strategic material reserved for industry. You won't be able to buy it. It will be unobtainium. But wait, the skeptics scream. We will just recycle. We will take the silver out of old cars. We will mine the landfills. This is the recycling myth, and it is dangerous because it gives politicians a false sense of security. Here is the forensic reality of silver recycling. Gold is recycled at a rate of nearly 90%. Why? Because it is concentrated. It is in bars. It is in jewelry. It is easy to melt. Silver is recycled at a rate of less than 20%. Why? Dispersion. Silver is the vampire dust of industry. It is sprinkled in microscopic amounts across billions of devices. There is 0.1 gram in your phone. There's 0.5 gram in your laptop. There is a thin film in a solar panel. There is a nano layer in a missile guidance chip. It costs more energy and money to extract that silver than the silver is worth. So it goes to the landfill. We are literally burying billions of ounces of silver back into the earth, but in a form that is impossible to mine. Now consider the solid-state battery. Yes, it has more silver. But do you recycle a car battery next year? No. You recycle it in 15 years. The silver that goes into a Samsung solid-state battery in 2026 is locked away until 2041. It is removed from the supply pool for a generation. So the recycling wave that everyone is hoping for, it won't arrive in time to save us from the shortage of the 2020s. The deficit is structural. The consumption is destructive. The sequestration is long-term. Most people will ignore this data. They will look at the red candle on Friday and go back to sleep. They will trust the headlines. But you are still here. You are listening to the math. If you want to be part of the 1% who prepares for the shortage before it hits the news, make sure you are subscribed. Make sure you have turned on the notification bell, because the next signal might be the last one you get before the window closes. Now let's look at history, because the experts on CNBC love to bring up 1980. They love to talk about the Hunt brothers. They tell you that silver is a bubble just like it was 45 years ago. They tell you that the government will crush the price just like they did back then. But if you look at the forensic data from 1980 and compare it to 1974 and compare it to today, you realize they are making a fatal category error. In 1980, the price spike was driven by three men, the Hunt brothers. They were speculators. They bought silver on leverage because they were afraid of inflation. They didn't need the silver. They just wanted to hold it. The world was awash in physical metal. Families were melting down their tea sets. Coins were flooding into the refineries. Supply was everywhere. It was a monetary squeeze. And monetary squeezes can be broken by changing the rules. The exchange raised margins. The price crashed. The silver came flooding back out of the vaults. But today is different. Today is the inverse of 1980. The buyers are not three brothers in Texas. The buyers are Samsung, Toyota, Apple, Tesla, the Chinese government. They are not speculators. They are industrial users. They are not buying silver to hedge against inflation. They are buying silver to conduct electricity. They are buying silver to make their products work. And here is the most critical difference. In 1980, demand was elastic. When the price went up, people bought less jewelry. People took fewer photos. Demand collapsed. In 2025, demand is inelastic. Samsung cannot stop buying silver just because the price goes to $100. If they stop buying silver, their battery factory stops, their supply chain breaks, their stock goes to zero. They have to buy at any price. You cannot margin call a physics equation. You cannot force a solar panel to sell its silver back to the exchange. Once the silver is in the paste, it is gone. This is why the bubble narrative is a lie. Bubbles happen when price exceeds value due to speculation. This is not a bubble. This is a repricing of a strategic asset based on a structural shortage. We are seeing the return of the 1970s commodity cycle, but with a technological supercharger attached to it. In 1974, we saw an oil shock. The price of energy exploded because of a supply constraint. It didn't matter what the Fed did. It didn't matter what the interest rates were. The world needed oil. So the world paid for oil. We are now entering the silver shock. The world needs silver to transition away from oil. And the world is about to find out that silver is harder to find than oil. This brings us to the final myth, the myth of thrifting. Wall Street analysts will tell you that engineers are smart. They will tell you that if silver gets too expensive, Samsung will just design it out. They will use copper. They will use aluminum. They will use magic. This is the arrogance of the spreadsheet. Analysts think you can substitute anything if the price is right. Physicists know better. Silver is the most conductive metal in the universe. It is the best reflector of light. And now we know it is the only element that stabilizes the lithium anode. You cannot substitute silver with copper in a battery. Copper reacts with the electrolyte. The battery dies. You cannot substitute silver with aluminum. Aluminum forms an oxide layer. The battery dies. Samsung didn't choose silver because it was cheap. They chose it because it was the only thing that worked. They spent 10 years trying to find a cheaper alternative, and they failed. They hit the physics wall, so they are stuck. They are hostage to the periodic table, and that means you are sitting on the only asset that the global industrial complex must buy. The demand is inelastic. The supply is finite. The recycling is non-existent. And the historical parallel suggests we are in the early innings of a squeeze that makes 1980 look like a warm-up. But there is still one problem. Knowing the math doesn't put money in your pocket? Knowing the shortage doesn't protect your wealth if you buy the wrong thing. If you buy paper silver, you lose. If you buy the wrong mining stocks, you lose. If you buy high-premium collectibles that nobody wants, you lose. The banks are trapping you. The dealers are trapping you. And the government is watching. In Part 3, the final chapter, I am going to give you the Alpha Protocol. I am going to show you the specific type of mining stock that leveraged the 1970s boom by 25 times. I am going to show you why numismatics are a trap and an industrial squeeze. And I am going to give you the exit strategy, because every mania ends, and you need to know when to sell your silver to Samsung before they invent the next battery. The silver bomb is ticking. Part 3 is the detonation. You now possess information that 99% of Wall Street is ignoring. You know that the solid-state battery revolution requires a silver-carbon anode. You know that this single technology could consume over 100 million ounces of new silver annually. And you know that the geological wall means mines cannot expand fast enough to meet this demand. So here we are. The market is fearful. The retail investors are panicked by the red candles. But you are calm, because you know that this price drop is a glitch in the matrix. It is a temporary mispricing before the reality of the Samsung scenario hits the ticker. But knowledge without action is useless. Being right doesn't pay the rent. Positioning pays the rent. How do you position yourself to profit from the silver bomb? Do you just buy coins? Do you buy miners? Do you buy ETFs? Welcome to Part 3, the execution. In this final chapter, I am going to give you the strategic playbook. I am going to break down the 3 lanes of the silver trade. I am going to expose the trap of collectibles during an industrial squeeze. And I am going to show you why the unhedged miner is the only stock you should own right now. The auto industry is about to panic buy. You need to front-run them. Here is how. Lane 1. Physical metal. This is your insurance policy. This is your wealth preservation. This is the arc. But in an industrial squeeze, the rules of what to buy change completely. For years, dealers have pushed semi-numismatics, collectible coins, limited edition prints, Star Wars silver. They told you these hold value better. And in a normal market, maybe they do. But we are not in a normal market. We are entering an industrial vacuum. When Samsung needs silver for a battery, they do not care if it has a picture of a superhero on it. They do not care if it is a graded coin in a plastic slab. They care about one thing, the atom. They need raw silver to melt down into nanopowder for anodes. This means that in a true shortage, the premium on collectibles collapses relative to the spot price. Why? Because the industrial buyer sets the floor. If spot goes to $100, the melt value of your coin is $100. But nobody is going to pay you $150 for the art when the world is starving for the metal itself. The strategy is simple. Stop paying for art. Start paying for weight. In the Samsung scenario, ounces matter most. A 100-ounce industrial bar is the superior asset. Why? Number 1, lower premium. You get more silver for your dollar today. Number 2, liquidity. If you need to sell to an industrial buyer or a refiner, they want bars. Number 3, density. It is easier to store 1,000 ounces in bars than 1,000 ounces in tubes of coins. If you're buying right now at these levels, ignore the fancy stuff. Buy the cheapest, most recognizable government or corporate bullion you can find. Maples, eagles, generic bars. Your goal is to accumulate the maximum number of grams of silver before Samsung clears the shelf. Lane 2. The mining stocks. This is where life-changing wealth is made if you pick the right horse. But there is a trap here too. It is called the hedging book. Imagine a mining company called Loser Gold Corp. Last year, when silver was $25, they were scared. They wanted to guarantee a profit. So they signed a contract to sell 50% of their production at $30 for the next 3 years. Today, silver is over $60. Loser Gold Corp is selling their silver for $30. The bank keeps the extra $30. Their stock will barely move. They missed the party. Now imagine Winter Silver Inc. They believed in the shortage. They refused to hedge. They sell every single ounce at the spot price. Today they sell at $60. If silver goes to $100, they sell at $100. This creates operating leverage. If their cost to mine is $20, at $30 silver they make $10 profit. At $100 silver they make $80 profit. The price went up 3 times. The profit went up 8 times. Their stock price will likely go up 10 times or 20 times. The strategy is mandatory. You must audit the miners you own. Go to their quarterly reports. Look for the section labeled Hedging and Derivatives. If you see forward sales, run away. You want 100% unhedged exposure. And you want primary silver miners. Most silver comes as a byproduct of lead or zinc mines. Those companies don't care about silver prices. It is just a bonus to them. You want a company that lives and dies by silver. The Samsung scenario creates a bidding war for these companies. Battery makers might start buying equity in miners to secure supply. If Samsung buys 10% of a junior miner to lock in their flow, that stock goes to the moon overnight. Lane 3. Geography. We touched on this, but it is critical for the battery metal narrative. The United States government and the European Union have passed laws. These laws require battery materials to be sourced from friendly nations. This is to qualify for EV tax credits. If a car company buys silver from a sanctioned nation, no tax credit. If they buy from a mine in Nevada or Ontario, huge tax credit. This creates a 2-tier market for silver miners. Clean silver versus dirty silver. Clean silver will trade at a premium. Samsung and Tesla will pay more for silver from a safe jurisdiction because it keeps their supply chain legal. The risk is in Latin America. Mexico and Peru are the giants of silver production. But as prices rise to $100, the temptation for their governments to seize the mines becomes 100%. We are already seeing labor strikes and blockades in these regions. The strategy is defensive. Tilt your portfolio toward Tier 1 jurisdictions. Canada, USA, Australia. These countries have stable laws and critically they are strategic allies for the battery supply chain. A mine in Idaho is worth 5 times more to Tesla than a mine in Bolivia, even if the silver is the same. Because the Idaho mine is secure. If you own mining stocks, check the map. If 100% of their assets are in a country with a history of seizing assets, you are holding a ticking time bomb. Finally, let's talk about the exit. I told you in the last video not to sell for fiat currency, but you do need to rotate out of the battery trade eventually. Technology moves fast. Right now, the silver-carbon anode is the winner. It will drive the market for the next 5 to 10 years. But in 2035, maybe they invent a graphene anode that uses no silver. Maybe they invent a sodium battery that kills lithium-ion. Commodity supercycles driven by technology usually last 7 to 10 years. Think of uranium in the 2000s. Think of cobalt in 2017. We are at year 0 of the silver battery cycle. You have a runway. The squeeze is just starting. Friday's price was the starting line. But you must stay vigilant. If you see headlines in 5 years saying, Toyota invents silver-free, solid-state battery, that is your signal. That is when the structural deficit might ease. But for the next decade, the math is locked in. Factories are being built today designed for silver. They cannot switch gears for at least 2 product cycles. So for the foreseeable future, the Samsung bid is the floor under the silver price. The strategy is to ride the S-curve. Accumulate now, hold through the mania, and look to swap into land or income-producing assets when the headlines become euphoric. Do not marry the trade forever. Marry the macro. Date the tech, so you have the playbook, physical bars, weight over art, unhedged miners, leverage, safe jurisdictions, security. But there is one immediate hurdle left, the psychological warfare. Next week is going to be brutal. Not necessarily for the price, but for your emotions. The banks know they are in trouble. They know the Samsung narrative is taking hold. They know the vaults are empty, so their only remaining weapon is volatility. They will try to shake you out. You will see days where silver is up $3. You will see days where silver is down $3. They want to induce motion sickness. They want you to get so stressed watching the chart that you hit the sell button just to get some sleep. Do not fall for it. Remember the Samsung scenario. Does a $3 price drop change the chemistry of a solid-state battery? No. Does a margin hike change the fact that Samsung needs 100 million ounces? No. Does a scary headline on CNBC put silver back into the ground? No. The fundamentals are inelastic. The price volatility is noise. You have to detach yourself from the daily ticker. If you are checking the price every 5 minutes, you're playing their game. You are letting them rent space in your head. Instead, look at the premiums. If spot drops to $60, but the dealer is still charging $80, the drop is fake. Look at the inventory. If spot drops, but the out-of-stock banners stay up, the drop is fake. The paper price is going to be weaponized against you, but the physical reality is your shield. We are watching the end of a 40-year cycle of financialization. We are watching the return of the tangible, the return of the real, and the transition will be volatile. It will be violent. It will be confusing. They will throw everything they have at this market to keep it under control. Margin hikes, circuit breakers, media blackouts, narrative suppression. They will try to bore you to death. They will try to scare you to death. But they cannot change the math. They cannot fix the deficit. And they cannot stop the shift. This is why capital cycles exists. We are not here to entertain you. We are here to arm you. We are here to give you the forensic tools to see through the fog, to understand the difference between a signal and a distraction, to understand the difference between a market correction and a regulatory intervention. So I am asking you now, not just to subscribe, but to enlist. This channel is an information network for the 1% who refuse to be victims of the transition. We are building a community of forensic detectives who verify everything, who trust nothing, and who prepare for the inevitable. If you are ready to think for yourself, if you are ready to take responsibility for your own financial sovereignty, then click the subscribe button, turn on the notifications, and join us in the comments. Tell me what you are seeing on the ground. Are premiums rising in your area? Is inventory getting tight at your local dealer? Share your data, because we are the market now. The institutions are trapped in their own web of leverage. They are paralyzed by their own rules. But we are agile, we are liquid, and we are awake. The margin hike was their move. Taking possession of the physical asset is our move. The game is still being played, but the board has tilted. And for the first time in 40 years, gravity is on our side. The deficit is the gravity. And eventually, gravity always wins. Welcome to the shift. I will see you on the other side. Class dismissed.